Pierre says, excuse me, can you explain the advantage of a strangle? Sold, covered call, and CSP. Okay. Well, it's not a strangle. A short strangle, Pierre, is not a CC covered call, and it's not a CSP cash secured put. A short strangle is a naked call and a naked put. It has a very high margin requirement and has a very potential high risk in fluid markets. The short strangle position is when we sell an out-of-the-money call option without the stock or without another call bought underneath it to protect it, such as in a credit spread or an Iron Condor, combined with a sold put. It's not cash secured, it's a naked put. Okay, so you have a certain margin requirement. The brokers have this calculation that they use for this Pierre to cover sold call and sold put strike price. Essentially, what does this position give you? Now, it gives you infinite risk to the downside if the stock falls to zero, and it gives you infinite risk to the upside because the stock can move up to infinity. Now, we never see the stock that moves up to infinity. If any of you come across the stock that's going up to infinity, please let me know. I'd like to trade it as well. So it's an unprotected, essentially, position. What is the advantage of it? Well, the advantage of it is you get an increased net credit above what you would with a vertical spread because you're not buying any of the outside wings to limit the loss to the upside as you would in a bear call credit spread or the downside as you would in a bull put credit spread. You don't have a known risk as you do with a vertical spread. You're enhancing the premium significantly by doing that, but you can't get nothing for free, right? The broker is going to have that equation there for the margin requirement. It's the short call strike, naked call strike, plus the put premium times some ratio. So the margin can be fairly steep to cover the short strangle position. Now I'm just going to take an example. These are weeklies out here. I think we did this during a webinar. I'm just going to go to the default. Oh, I'm in Iron Condor. Never mind. I'm sorry. Let me go back to short strangle. I'm really sorry about that, Pierre. Let's just go back to there. Let's go to short strangles as we meant to. All right, there's only one there on the initial values. Now, a lot of the reasons why there's only one is we're trying to be very safe with our default criteria for investors who use this strategy. We're forcing a higher probability between and sometimes what's called the probability sum. We keep volatility low because we don't want something that moves, and you definitely don't want earnings between now and expiration because you don't want a sudden 15 to 20% drop because that could result in significant losses on the position. However, there are some investors who are more bold and trade deep, attempt to trade, I should say, deep, out of the money, short strangles on stocks with earnings. I don't do that. I would never do that. Maybe they're making a profit. They have stronger stomachs than I do, and I don't have a lot of time to sit there and watch that the day of earnings to try to track it. But let's just take a look at BHP. Stock's trading at 53.55. Out of the money 60 strike call, out of the money 47.5 put, getting a total net credit of about $1.40, and that's only a 2.4% return, but we're assuming the worst margin requirement you could have. Your broker probably has a lower requirement in this case, okay? But in any case, let's take a look at what it is. As we saw, this is that profit and loss chart for a short strangle position. We sold an out-of-the-money 47.5 put for November, 49 days away. We sold an out-of-the-money November 60 call. We're right between the strike prices. We kind of want that, and we want a reasonable probability between. We see a low net credit because we're assuming the worst possible margin requirement on this position. And if I'm not mistaken, correct me if I'm wrong, Pierre, this you need to be on level 4 trading because it does involve selling a naked call that's not protected. Even though you have a naked put with it, that doesn't cover the obligation of the naked call position. So you have to have higher approval, which I think we talked a couple weeks ago, you do already have. Okay, so this is the short strangle. You get a higher premium than doing a naked call or naked put. You expose yourself to two different losses. You're getting a little bit of benefit with an increased net credit. For those of you that are on level 2 or level 3 trading, you can't do this. The more common approach, not that there's anything against doing these, Pierre, if you have the stomach for it and if you can peg the market pretty well and neutral positions. But where I'm going with this, most commonly what investors will do to get a better bang for their buck, in a sense, not as much premium, is rather than do the short strangle position, which has the high exposure to the downside and to the upside, we would simply add the outside wings to create an Iron Condor position. What do I mean by that? Well, we're selling a 60 call here for November on BHP. So I'd look to go out to November, 49 days away, and maybe buy the 62.50 or the 65 call, which would create a bear call credit spread. Let's do the 5 points. And at the same time, I'm going to buy 5 points away from my sold 47.5 put strike at 42.50. This is going to do what? This is going to drastically reduce this $1.40 net credit that I received from the short strangle position. But at the same time, it now gives me a controlled risk on the outer wings, where I can't lose more than 5 points, even if the stock suddenly shot up to 70. Don't expect that with BHP, or suddenly dropped down to 40. Again, don't expect that necessarily with BHP, but that's what can happen. This gives me a limited maximum risk. I have to put up the monetary requirement of $500. I'm only making 87.88 cents instead of the $1.40, but I have a known controlled cap in place because I'm combining a bull put credit spread with a bear call credit spread, and that puts me right into this position here. Also, I'm taking in less credit, but the worst I can lose is for what, let's put it here. Let's take these numbers out a little bit here. Let's just put this at 22 cents, for example. And yeah, let's just do that. I want to get a straight number, 88. Okay, so put us at 88. I'm sorry. I keep the 88 cents here, regardless of what happened, Pierre, of course, just like you would with the $1.40 in the short strangle position. But I only have to put up $500. And since I keep the 88 cents, even if I take that full loss in one direction or the other, the most I can lose is $4.12. So I'm still looking at a 21.4% return against my risk and without the high margin requirement. So the short strangle position is similar to an Iron Condor. It just doesn't have the outside wings. Many investors like to use the Iron Condor, especially on SPX, SPY, or NDX, because you have the known controlled risk in place. You don't have the high margin requirement. Your margin requirement, Pierre, might be lower to where the short strangle makes sense, but without proper management and without proper triggers, stops in place, or mental stops, alerts in place, they can result in significant losses. It's called a short strangle position, selling an out of the money call, out of the money put. It's not a covered call and a cash secured put because you're not covering either one. They're both open. Now, that being said, some investors will do that with owning the stock. In other words, they'll buy a stock and they'll sell an out-of-the-money call and sell an out-of-the-money put to enhance the premium. That's called a covered combination, which also has a higher cost basis on the covered combination because you have to cover the short put strike price, whether you do it as a cash secured put or use some margin as sort of a naked put. So you have to buy the stock and put up the requirement for the cash secured naked put. So it's almost double the monetary cost, but you're still getting, 1.5% here on the out of the money call and maybe 1.2, 1.5% there on the out of the money put. But on that example of BHP, instead of putting up 5,300 to buy 100 shares of stock and sell it, say, a 55 call for 1 or 2% premium, I also now selling, let's say, the 50 strike put. I've got to put up another $5,000 if I have to make that a cash secured put, if I'm only on level 1 or level 2, and I'm not using margin in my account. So that was for Pierre on the short strangles. And of course, as always, you can just go to our YouTube channel at any time and go right into the videos section, and you could do a search. I don't know how many I have on these, Pierre, but the title I would probably put it under would be Short Strangle. Short strangle adjustments from about a year ago, discussion on short straddles, which is when you use the same strike price, selling an at-the-money call and at-the-money put for a much higher premium, but you've got to manage it. Managing a short strangle and intro to Iron Condors. That's the one I was thinking above from 2 weeks ago. There's some other ones there on short strangle positions as well. So you can take through other content there. We talk a little bit about adjustments, a little bit about management, comparing the structure and risks and concerns, basic introduction and management, and leading again, as we just did, into why Iron Condors make some investors feel more comfortable because the risk is known to the downside.